Hi and welcome to ACC515. This is just a brief introduction to the topic and to topic one, which I thought my students might find helpful. The textbook, as you can see, is Financial Management by Titman et al. But I'm actually using slides from another Titman edition, so don't get too fussed about that. But essentially, the topic is financial management and just the introduction to it. My name's Dan Murphy and I'm the convener for ACC515. Just hang on while I get this moving. So the first question we'll have to ask is, what is finance and what is the study of finance? So financial management only really came about following the Great Depression in the late 1920s, early 1930s, which doesn't sound that long ago, but it's almost 100 years ago, which makes it relatively new. So finance is concerned with developing analytical tools to assist managers in their financial decision making. So in fact, for ACC515, we're teaching you a very different perspective to an accounting perspective, but we're looking at things from a financial point of view, and the two don't necessarily align, so just be aware of that. The important thing is that the skills that you'll learn in this subject are ones that you will apply throughout your business career, and also just through life in general. That you should develop some real skills which you'll find very, very helpful if you aren't already using them. So one of the questions that I got often asked in my role in public practice accounting is that a client would come in and they'd have a business proposition. They'd say, what's the value of it? And typically in my lecturing I always use fast food outlets. If you could see me, you'd understand why. But I'd say, what's the value of the McDonald's franchise at the moment? They're asking $5 million for it. Is that a good price? And these are the sort of questions you'll get as a practicing accountant or business advisor, and you expect to be able to come up with a response. So, is $5 million a good price? How do we know? How do we value that out? And hopefully at the end of this subject you'll have the skills where you'll be able to come up with an assessment of whether $5 million is in fact a good price for the asset that your client's proposing to buy. Or, in fact, you might be proposing to buy. So financial managers face three major decisions, and in this subject and in financial management more generally, we generally take the view that you're a financial manager in a large firm. So when we say a large firm, we're talking BHP Billiton or National Australia Bank or something like that. So we take a corporate focus. The question I just posed to you before was obviously a small business focus, but so it does apply across, but we generally take a corporate focus in explaining how these work. So the first decision the financial managers must make is the investment decision. What will we invest in? What investments should be undertaken? So, and I quite often use Mars, the international firm Mars, as an example. So because the head office is based where I am in Albury-Wodonga, and you might say, well, what investment will Mars make? Well, they're a business portfolio that is eclectic, to say the least. So their biggest market segment is in pet food, but they obviously also make Mars bars and Maltesers. They make all of the Master Foods products. They make Wrigley chewing gum. So where are they going to invest in any one time? All of the business managers in those businesses all have expansion ideas and ideas that they'd like to invest in, or new production lines or upgrades to equipment. So how do Mars decide what investments should be undertaken? How do they assess which is the best of those investment options? Then once you've made that decision about what we're going to invest in, how will we finance it? I just don't happen to have $100 million in my back pocket. Where will I get that $100 million from? Will I borrow the money? Will I go to the market and do a capital raising and get equity in? Or will I have a mix of those? So What's the best mix for me between debt and equity? So that's a finance decision. And finally, we've got the decision about cash flow management, which you can also call working capital management. So how do we best manage the cash flows from our day-to-day operations? Now, if we've got cash sitting in the bank, we're not earning much money on it. But if we don't have enough cash and we can't meet our day-to-day commitments, we'll be technically bankrupt. So we've got that risk to balance between earning more by having our money invested in long-term investments, and retaining enough cash to meet our day-to-day commitments. There's another decision that financial managers might consider, which is a profit allocation decision, or we could call it the dividend decision. So how are the rewards or profits from the firm to be distributed? What dividends should be paid to shareholders? How should we pay them? And how much profit should be retained in the firm for reinvestment in new projects? So if you're an investor in News Corp, for example, famously pay very, very low dividends. So they're reinvesting all of their profits back into the firm, and we hang on to those shares in the belief that at some stage, rightly or wrongly, Mr. Murdoch will pass some of those profits back to us as shareholders. So those are the decisions that financial managers are faced with. So what's the goal of a financial manager? Again, a challenging question. What's the goal of the firm? So many students will answer automatically, the goal of the firm should be to maximise profit. And if I'm an accountant, I would think that's a pretty good answer. I am an accountant, but I also lecture in finance, so I know that's not a great answer, and we'll get into that certainly in a second. So a subset of that is, what's the goal of a financial manager? Well, a goal of a financial manager should be to maximise the goal of the firm, shouldn't it? But we all know that the actual goal of any financial manager is going to be to maximise the satisfaction of their boss, of their immediate boss. So you've got that dual pressure and that challenge about how we and about who we work for and what we do. And so we should be working for the owners of the firm, but we don't know who the owners of the firm are, and we never will, because in a large firm, say BHP or NAB, a large proportion of our firm is owned by superannuation funds who hold the shares on trust for individual shareholders who have no say in how the firm's run. So who do we work for is a really valid question to start thinking about the context in which we're studying financial management. So I said before that the go-to answer for a lot of accountants is profit maximisation. Now, as an accountant with a fair bit of public practice experience, I have a pretty good understanding of why this is a really poor answer. Some of the problems with profit maximisation include the timing of returns. So, we could have two businesses with equal profit of $1 million. So, if we're going to use a financial year, 2018 to 2019, let's say two firms are going to have equivalent profits of $1 million. The first firm makes its $1 million from a cash flow that arrives, a check payment or a bank payment of $1 million, which occurs on the 1st of July 2018. Okay, so it's received up front. The other firm also has a profit of $1 million. So if we look at it in terms of profit, they're equal, but it doesn't actually receive a payment on the 30th of June 2019, so a year later. It books an accounts payable, or an accounts receivable, for $1 million. So there's been no cash received. Now, they both record a profit of $1 million for the 2019 financial year, but clearly there's some difference there. Another problem with profit is the uncertainty of returns. So clearly, in the example where we receive the cash, there is no uncertainty. We've got that $1 million. But if we look to the second firm, which has booked the accounts receivable, how certain can we be that we're going to receive that payment of $1 million? and when will it be received? So profit doesn't take into consideration the uncertainty of returns. It doesn't take into consideration the timing of those returns. And finally, we have the issue of profit manipulation. So this is where managers or accountants or whatever can manipulate the profit to make it become a figure that that suits their particular purposes. Now this is very common. Many of you who are working in public practice will have experienced at some point or another how profit manipulation can be occurred. So you'll have a client, you'll take it into for partner review, and the partner will say, well, that's too much tax. Go back and see what you can do about it. And so we can use accounting techniques, which are not illegal, but sometimes illegal techniques are used. But we can use legal accounting techniques to manipulate the profit, to lower it or increase it as we see fit. So these are the problems with profit maximisation. The dominant paradigm at the moment is shareholder wealth maximisation. Under shareholder wealth shareholder wealth maximisation can be considered to be the same as maximising the firm value by maximising share values. So shareholder wealth equals the market value of the ordinary share. So if we undertake the activity that increases the share price, we're maximising shareholder wealth. The challenge for this is the agency problem. How do we get managers to act on our behalf, who are acting as our agent, to act on our behalf? So this draws from agency theory, and it's an issue where the modern corporation is characterised by ownership of wealth without appreciable control. So that's a shareholder, and particularly a shareholder who's holding shares through a superannuation trust. So we have ownership of wealth, but we don't have any control, and control of wealth without appreciable ownership. So that's a manager. So if you imagine the managers of, including the CEO and down of a major corporation, they have control of all that wealth, but without appreciable ownership, and that's the nub of the agency problem that was first espoused by Berle and Means. And you can see Adolf Berle, an unfortunate Christian name, but in about 10 years people stopped naming their children Adolf after the Second World War. So what does this mean to us? The owners without control? Well, it's the shareholders. And who has control without real ownership? That's the managers. So the problem that owners face is, how do we make managers act in the interest of owners and not in their own self-interest? So underlying this issue of agency theory is a question about the nature of a firm. It's something we don't really often think of, but why do firms even exist? Many of us work for firms or work for organisations. Why don't we just work for ourselves and subcontract to the firm? So this lovely fellow, Ronald Coase, who recently passed away at a very old age, wrote a treatise called The Nature of the Firm. It was written in 1937. He was awarded the Nobel Prize in Economics for it in 1991. So it's a bit of a slow burn, and it took a lot of people a long time for people to realise the value of the work that he'd done. His work was based on transaction cost economics, and talked about how the transaction costs exist. Now, right now at the start of the session, you guys will be experiencing some transaction cost economics because you don't know how good I am as a lecturer. I don't know how good you are as a student. We'd like to know, we'd like to trust each other, but we have to invest some time and energy to understand that. If this was the second time you'd had me lecturing, or the second or third or fourth or fifth time you'd had me lecturing, those transaction costs would be a lot less, because you'd understand my strengths and weaknesses as a lecturer. I'd understand your strengths and weaknesses as a student. And so we wouldn't have to, there wouldn't be that asymmetric knowledge base that there is at the moment. So if we reduce transaction costs by joining as a firm, there's savings that we both would benefit from. All right, and that's the fundamental basis of COSA's work in explaining how transaction cost economics can explain the development of firm. Because corporations weren't around forever. They're a relatively new institution, and a little bit too taken for granted for my liking. So this problem of agency has been around for a long time. So Adam Smith, who many of you will understand is often seen as the father of modern economics, and wrote a book called The Wealth of Nations, which is still cited by many people, and particularly those who adopt a neoliberal ideology or paradigm will often talk about the power of the markets and the invisible hand of the market, which was first enunciated by Smith in The Wealth of Nations. But Smith is often misquoted and or quoted slightly out of context, particularly regarding that area and how the market is he didn't really hold the view that the market was sacrosanct and should be completely trusted. And this is what he talked about the problem of agency. And he's talking about managers, and he said how managers, being the managers rather of other people's money than of their own, cannot be expected to watch over that money with the same vigilance with which they would watch over their own money. So he's, in plain English rather than in the English of 1776, he's saying we can't expect managers to be as vigilant about our money as they will be about their own. So how do we ensure that our workers are providing us with their best effort? How do we ensure that people acting in an agency relationship act in our best interest? And a really famous text is this, it's not text, is this journal article by Jensen and Meglin, The Theory of the Firm, Managerial Behaviour, Agency Cost and Ownership Structure from 1976. It's one of the most cited economic papers of all time. And basically they expanded on agency theory and talked about some of the issues within agency theory. By the way, you're not going to find this stuff in the textbook. This is just stuff I've prepared. So agency theory basically says that firms involve a set of contractual relationships amongst individuals. Going back to COSA's work, we've got a contract, and there's transaction costs within those contracts. So agency relationships exist between employees and managers, between managers and the board of directors, between the board of directors and shareholders, between managers and shareholders, and so it's a tangled web of interactions. So agency costs are those costs which can include reduced share price associated with potential conflict between managers and investors when these two groups are not the same. So in small business, the manager and the owner are one and the same, but as soon as you get into larger businesses, that's not the case. So shareholders are the owner principals, and there's often a diversification of owners and agents' interest. Owners want to maximise their investment returns, where the manager, they want to keep their job and their personal income and security, whether that be power, prestige, bonuses. So agents do not always act in the best interest of the principal. And if we just look at the fundamental principle of diversification of risk, which we'll be covering in more detail later in the subject, but investors, it makes sense that you don't put, to use the old saying, you don't put all your eggs in one basket. So if you're an investor, if you're smart, you don't invest just in one firm. You invest in a basket of firms and you diversify your risk in doing so. So if one goes really, really bad, you can best bet that one of the others is going really, really well. And overall, you balance out your risk, and you reduce your risk through diversification. The problem for managers is that all of their risk is tied up in their main source of income, which is of course the one firm. So if they're the CEO of the one firm, they're quite they're quite in quite a risky position. If the firm goes really, really bad, they will be sacked. So quite often, the managers will be more risk averse than owners, because owners have an investment in a number of different firms, and to achieve effective diversification, the base number is about 20. So they'll be invested in 20 different firms. So because they've invested so widely, they would actually like the manager to take a couple of risks and maybe go for a risky business proposal, because they're diversified. Whereas the manager is thinking, well, look, it's great that they want me to do this risky proposal, but if it goes bad, I'm going to get the sack and I'm going to lose my $10 million a year job. So they will be more risk adverse, where they know I can be quite conservative, and I'll earn within in the top third of market earners, and I'll get my $10 million pay and I'll get my bonus without taking that risk. Why would I take that risk? So you get this disparity between what the owners might want the manager to do and what the manager wants to do. Remembering, agency theory is based on this underlying concept of the economic rational man, that we will all act in our own self-interest in an economically rational manner. And there's some criticisms of that I'll talk to shortly, but just something to keep in your mind. So some of the challenges you can have is there's residual loss, the reduced value of the firm due to managers acting in their own best interest. So there tends to be some short-termism, so where we take short-term decisions rather than long-term decisions. I've got, for example, Flight Centre there. Now the Australian guy who established Flight Centre a few years ago now, tried to buy it back. So he publicly floated, made all his money, Graham Turner I think it is. But Flight Centre, very successful business, but he thought that they needed to make some fundamental change. Embracing Flight Centre is still basically a retail operation, so it's not as online as some of its competitors, and flights and travels is an area where there's been some fundamental change as the internet has been adopted. So, but he felt that they were taking short-term options and needed to take some long-term pain, some short-term pain to have some long-term gain, but has been unable to get that through. There's also the monitoring costs that occur. So auditing, we're conducting audits to make sure the managers are behaving. So we're trying to monitor behaviours. And then we have bonding costs, which are agency costs, which we have bonuses, share option plans, lots of costs trying to ensure that managers act in the interest of owners. And it's a bit of a truism at the moment, is that I must focus on short-term profits. I must focus on short-term profits, which means quite often we're not thinking about the long-term interest of shareholder profits or shareholder value. And when you think that most businesses invest, or most investors invest for the longer term, it's not in the best interest. So they're generally held as 10 principles of financial management. I think in the Titman textbook they use 5, but it's basically the same thing, just a little bit short with some explanation. So I'm just going to quickly run through. The first principle is the risk-return trade-off. We are all risk averse. So this means that we don't like risk. Doesn't mean we won't undertake risk, but we are all risk averse. What it means is that we don't take on additional risk unless we expect to be compensated with additional return. So there's a direct relationship between expected returns and the amount of risk we'll undertake. So a way to think about this is, I always use the example of walking across the bridge of death. And what you do is you've got to walk across a plank over the chasm of death, and if I fall off I'm going to die. what would I walk across the bridge for? And typically I'd say, yeah, look, $1 million. And I'm looking at it and the plank's quite wide, and back in my youth I was quite athletic. I feel pretty confident that I'll get across there, and so I'd probably walk across for $1 million. And then as I approach the plank, and the bridge of death, it's only 20 metres, but I notice that there's a bit of wind coming up from the chasm, and the plank's vibrating a little bit. And I start thinking about my family and everything like that, and I think, oh, really, $1 million? And then they offer me $2 million. Well, definitely walking for $2 million. I'd hop across for $2 million. And then as I approach it, I notice there's these little Aztec warriors afield, and they're shooting little arrows. They're not very accurate, but one or two of them are clattering against the bridge. Would I still walk? And then, and so what's happening is with this example, I'm increasing the risk. And as the risk increases, the reward needs to keep increasing until, ultimately we get to the point where there's an offer made that I'll walk across, I'll face near certain death for, which of course, it's a bucket of KFC. Like, who wouldn't go across for a bucket of KFC? So just understand that as risks increase, we expect rewards to increase until we ultimately receive a bucket of KFC, in which case we're all going across. If you're not, don't tell me. I really don't want to know, because fast food's very important to me. So the second principle is the time value of money. That's where $1 received today is worth more than $1 received in the future. There's a number of reasons for that. We've talked about risk and so on and so forth. The third principle is cash, not profits, is king. So we use cash flows, not accounting profits, to measure wealth. And the fourth principle is we only count incremental cash flows. So it's only what changes that count. So if we're considering two options, we've got one option A, investment, option B, investment. We only consider the difference between those. So incremental cash flows are the extra cash flows, which can be positive and negative, which occur as a result of a new project. Principle 5 is the curse of competitive markets. So you might look at the work of Michael Porter from Harvard on competitive advantage. It's not that easy to find an exceptionally profitable project. So we can look at making the markets less competitive by differentiating our product or achieving a cost advantage over competitors. Principle 6 is that capital markets are efficient. So this is the rule that markets are quick and prices are right in the share market. So efficient markets are those in which the values of all assets and securities at any instance in time fully reflect all of the available information. Now look, that's an assumption, and it very much depends on the ideological or political paradigm you want to adopt. I don't believe markets are fully efficient, but it's one of the fundamentals of finance, so we teach it to you. But fundamentally, I don't hold that the markets are God, so to speak. Agency problem, we've already talked about it. Managers won't work for owners unless it's in the manager's best interest. So how do we make it in their best interest? We give them share options. If the share price gets to this, you get 1 million shares for one, worth $10 each for 1 cent, and so as a bonus. Principle 8, with taxes bias business's decision. Principle 9 is all risk is not equal, so some risk can be diversified away. That's firm-specific risk. However, we cannot diversify away market risk. So we'll be dealing with that as we go through this. And Principle 10 is ethical behaviour is doing the right thing, and ethical errors can end careers. As firms become more and more important, they have a social responsibility. And we need to understand that ethical dilemmas are everywhere in finance, and the word ethics and the word social and the word responsibility. They're loaded words. So we will each have a different construction of what those words mean and what social responsibility is and what corporate social responsibility is and so on and so forth, and ethics. And so we end up with this problem of whose ethics. My ethics, your ethics, Turnbull's ethics, Shorten's ethics. Whose ethics should we adopt? Whose ethics are appropriate? Perhaps it's Peter Dutton's ethical approach is the most appropriate. So just be aware of that. Just by way of self-declaration. Now, with these sorts of things, a lot of the material you receive is loaded, and it's sort of so loaded with sociological intent and sociological content, and it's always handy to understand the viewpoint of. So politically, I'm a long way left of centre, and I'd call the ALP centre, the ALP and Liberal Party, to me virtually indistinguishable. So I'm a long way left of where they are, but I teach a very right-wing paradigm, but I'm always critiquing it from my left-wing sense. So when we talk about ethical considerations, I have a particular ethical view. I try not to put it, but I'm pretending to you if I don't sort of self-declare. So two really, you'll be studying ethics in other topics, I would presume. But there's two ethical approaches I'm going to talk to you about, which is teleological ethics, which is a theory of morality that derives duty or moral obligation from what is good or desirable as an end to be achieved. Now, just to give you a hint, so what of the problems we face with this is what you think or good is desirable will be different to what I think is good or desirable. So what our Treasurer Scott Morrison thinks is good and desirable is completely different to what I think is good or desirable, and you will have a different view, I would imagine, between all of us. So this is part of the problem when we're looking at morality. So I can't really teach you morality. That's something you'll develop from your own, but hopefully what I can help develop is an understanding of ethics and morality and how they impact on us. So teleological ethics is generally where what is best for the greater number is considered to be important. Deontological ethics is where the ethical action is the ethical standard is based on whether the action is morally right. So to give a really, and it's quite a coarse analogy, if we're in a classroom together, we're in a virtual classroom, but if we're in a classroom together and a terrorist knocks on the door and there's 20 of us in there, and I answer the door and they say, listen, we know you're running a class, you have the option of sending one person out, one student out, and we're going to kill them, or if you don't do that, we're going to come in and kill everybody. Now, teleological ethics would say we pick one person and send them out. That's really bad for that one person, but for the greater number, it's going to be a better outcome. Deontological ethics says we can't do that because the act of sending someone out is morally wrong. And you can see the problems. That means we all die, but would be morally correct. So this is a sort of challenge that you're sort of faced with all the time. So if you can consider teleological ethical approaches and deontological ethical approaches, just as a hint, like I try and be deontological, and quite often that means cutting off your nose to spite your face type action, and I'm wary of that. Obviously, like everyone else, I pretty much fail in trying to do that. The most common business approach is the teleological approach, but that means there's some quite bad things happen, but we can say, oh, it's for the greater good, when it's not really clear what the greater good is, and some of the crimes that are being committed in Australia at the moment for what the government describe as the greater good or national security in quotation marks, these are things that we've got to wrestle with. So unethical behaviour can result in damage to the firm in terms of reputational risk. So at the moment we've got the issue around the banking industry and the Royal Commission, and things like the damage that was done to James Hardie through their asbestosis behaviours. And unethical behaviour can damage personal reputation and career prospects as well. So these are things that we need to think of. So the new multinational firms, some of the things we need to think of here, I'm not going to spend a lot of time with these, is there's been this acceptance of free market systems in developing countries. We've had deregulations of local market. There's been the internationalisation of the Australian economy and the reform of the tax system, increasing privatisation, and improvements in technology and the rise of virtual markets have led to this notion of this new and very powerful multinational firm that we are kind of kowtowing to at the moment. It'd be good for you guys to review the global financial crisis, the scale and impact, some of the reforms that have occurred around it, whether they've been effective, the continuing impact on our economy and the world economy, the dangers of financial engineering. And it's good to look at the relevance of the 10 principles of finance in the context of the global financial crisis and how that hurt. Try and get a sense of what caused the GFC. And there's different arguments. Some people blame China and its rigid policy. So, China was a massive export, so it had a massive exporter, so it had a huge amount of financial of international currency. So if you imagine every time that the Australian economy purchased something made in China, we had to buy Chinese currency, of course, to do that, which means we're selling Australian currency. So China end up with this massive chunk of Australian currency, of the euro, of the US dollar. What did they do with it? Well, they lent it to us. So they lent it back to hedge funds and stuff like that, and that glut of money is, some people accuse of being the cause of the GFC. I don't really hold to that. It's a factor. For me, the GFC came about through the greed of financial managers working in financial institutions. So through the greed of us, and we developed these financially engineered products, and which ultimately no one understood and led to the global financial crisis. So if you want to get an idea about the global financial crisis, there's nothing better to do than watch something which is enjoyable, but gives you a really good overview of what went on in the GFC, of part of the GFC anyway. But you get the idea about it, anytime you can have that Australian actress Robbie in a bath drinking champagne, in a bubble bath drinking champagne, explaining to you rather than me, it makes a lot of sense that would be a better option for you. Another thing that I would presume that many of you have seen is the film Pretty Woman, which is very old. But again, essentially that film is about this subject. You probably didn't realise it when you were watching it, but hopefully next time you watch it, you'll pick up it, and I'll talk more about the aspects of financial management which are covered in Pretty Woman. And again, I find it kind of interesting to use these real examples or public media examples of financial management. So you can see that it is part of our lives, and it is ongoing, and they're very real issues that you have to deal with. So quickly looking at financial markets, the financial markets is anything financial institutions and businesses which provides funds to non-financial institutions. So in essence, obviously it's a virtual market. And savings deficit units we generally consider are businesses. Savings surplus units are households, and the financial markets facilitate the transfers of funds between these entities. and it's done through direct flows and indirect flows. So net savers of funds are the suppliers of funds, and net borrowers of funds have a shortage, and the funds transferred through financial intermediaries, which can be superannuation funds, banks, hedge funds, a range of different methods. Financial markets, of course, do increase efficiency, so they're important. If the net borrowers had to go and knock on people's doors to create the funds, it would be quite difficult for them. When we're looking at assets, again, this is just helping you with language. So real assets are tangible assets, houses, equipment, inventory, big red trucks. Financial assets are securities. So when we talk about securities, it's an American term, which we're talking about shares or financial assets. So these are essentially claims for future payments. So an IOU is a financial asset. Owners of these financial assets anticipate earning a future rate of return. So typically some of these might be treasury bills, corporate bonds, preferred shares or ordinary shares. So we're left asking, what's the risk of each of these? Which of these will earn high returns? And is there a relationship between that high returns and risk? And I've already talked about that direct relationship between risk and return, that if we take extra risk, we will expect higher returns. So the riskiest of these, we would expect to have the highest return. The direct phase transfer of funds is where savers provide cash directly to firms, and that can be through the direct purchase of IPO on an initial public offering of a firm's shares. But more often than not, it's money transferred through intermediaries. Okay, so I'm going to leave that there now in terms of the intro. So the takeaway menu for this is financial management provides you with important tools for your business accounting career. You should understand shareholder wealth maximisation is a dominant paradigm, and it's evidence everywhere. So we're seeing that in the policies of the federal government at the moment, where they're suggesting lowering corporate tax rates, which will increase wealth in corporate wealth, which will trickle down to shareholders, and will also encourage firms to invest more and grow jobs. So that's, there's very much a political paradigm to financial management. We use cash, not profits, for financial management purchases. Understand that cash has a time value, so $1 today is worth more than $1 in the future. And from today, I hope you will understand the agency problem and its underlying assumptions, about us all being economically rational, which I believe we're not, and understand how, as owners, we incentivise our managers to work in the interest of owners rather than themselves. Okay, I hope you enjoyed this, and I'll be preparing some more for other topics. Thank you.